Hey, what's up everyone? Welcome back to the channel. So tax time is rolling around again, and if you've been buying, selling, or trading crypto this year, this video is for you. Because here's the thing, the ATO has been very clear that crypto is taxable in Australia. In fact, they've been ramping up data matching with crypto exchanges, so thinking they'll never know is no longer a strategy. But the good news, most of the mistakes people make are totally fixable, and honestly, pretty easy to avoid once you know what they are. So today, I'm breaking down the 5 biggest crypto tax mistakes Australians make every single year. And, more importantly, exactly how to fix them. Let's get into it. Okay, hands up. How many of you have ever swapped one crypto for another and thought, hey, I didn't cash out to dollars, so that's not a taxable event? Yeah, that's mistake number 1. And it's one of the most common ones out there. Here in Australia, the ATO treats every single crypto-to-crypto trade as a taxable event. So when you swap your Ethereum for Solana or your Bitcoin for USDC, that's a disposal of the original asset, and you're on the hook for capital gains tax on any profit you made. Let me give you a quick example. Say you bought one Ethereum for $2,000. A year later, ETH is worth $5,000 and you swap it for some Solana. Even though you never touched Australian dollars, you just made a $3,000 capital gain, and the ATO wants their slice. Record every single trade, the date, what you swapped, what you got, and the AUD value at the time of the transaction. Tools like Coinly can automate a lot of this if you connect your exchange accounts and wallets. Trust me, doing this as you go is so much less painful than trying to reconstruct 2 years of trades at 11 p.m. on the 30th of October. Alright, mistake number 2. And this one actually costs people money in the other direction. If you've held a crypto asset for more than 12 months before selling or swapping it, you're eligible for the 50% capital gains tax discount. That means you only pay tax on half the gain. So that $3,000 profit from my earlier example, if you held for over a year, you'd only be taxed on $1,500. That's a massive difference. The mistake people make is either A, they don't know about this discount at all, or B, they accidentally reset their holding period by staking, wrapping tokens, or moving to a different wallet and assuming it counts as a new purchase. Track the acquisition date of every coin you buy. If you're getting close to that 12-month mark, it might be worth waiting before you sell. A few extra weeks of patience could literally save you hundreds or thousands of dollars. And quick note, wrapping a token, like converting ETH to WETH, or moving assets between your own wallets does not reset the clock, as long as you can prove you still own them. But always double-check this with a tax professional for your specific situation. Okay, this one trips up a lot of people who are deep in the crypto ecosystem, because it's not just about buying and selling on Coinbase or SwiftX. The ATO has been increasingly specific about how DeFi, NFTs, and staking are taxed, and spoiler, most of it is taxable. Here's a quick breakdown. Staking rewards and yield farming income. These are generally treated as ordinary income at the time you receive them. So if you earned $500 worth of ETH staking rewards, that $500 is assessable income for the financial year you received it. NFTs. Buying and selling NFTs is treated the same as other crypto assets. If you flipped an NFT for a profit, CGT applies. DeFi lending, liquidity pools. This is where it gets complex. Adding and removing liquidity can trigger taxable events, and the rules around this are still evolving. Don't assume that because something is on-chain or in a DeFi protocol, it's somehow invisible to the ATO. They're getting smarter every year. Use a crypto tax tool that supports DeFi and staking imports. Many of the platforms I mentioned earlier handle this. And if your DeFi situation is complex, it's genuinely worth paying an accountant who specializes in crypto. They can save you more than they cost. Alright, we're at mistake number 4. And honestly, this is the root cause behind most of the other mistakes. Bad records. The ATO requires you to keep records of every crypto transaction for at least 5 years. And I mean every transaction, the date, the amount in AUD at the time, what exchange or wallet it was on, and what the transaction was for. Now I know what you're thinking, sounds like a lot of work. But here's the thing, if the ATO audits you and you can't produce records, they can make their own assessment of what you owe. And I promise you, their estimate won't be in your favor. The other issue is that exchanges change, get hacked, or go bankrupt. Remember FTX? Celsius? If your records only live on those platforms, they might be gone. Start using a dedicated crypto tax platform. Seriously, this is the single best thing you can do. Connect your exchanges and wallets, let it import your history, and export a CSV backup regularly. And here's our final mistake. And this one is a bit of a silver lining if you've had a rough year in the market. A lot of Australians don't declare their capital losses because they figure, it's a loss, what's the point? The point is this. Capital losses can be used to offset capital gains. So if you made a $10,000 gain on Bitcoin but lost $4,000 on some altcoin that tanked, you only pay CGT on the net $6,000. That can make a significant difference to your tax bill. And if your losses are bigger than your gains in a given year, you can carry those losses forward to offset future gains, potentially for years. But here's the catch. You can only claim a capital loss if you actually declare it. If you just quietly ignore those bad trades and don't report them, you lose that benefit entirely. Report all of your transactions, the wins and the losses. Make sure your crypto tax software is picking up every disposal, including the coins that went to zero. And if you're in a big loss position this financial year, it might also be worth considering whether there are any gains you want to crystallize before June 30 to take advantage of those losses while they're fresh. Chat to your accountant about this. A bit of tax loss harvesting strategy can go a long way. All right, so there you have it. The 5 biggest crypto tax mistakes Australians make every year. Number 1. Thinking crypto to crypto swaps aren't taxable. They are. Number 2. Missing the 50% CGT discount for assets held over 12 months. Number 3. Ignoring DeFi, staking, and NFT income. Number 4. Keeping terrible records, or no records at all. And number 5. Not declaring your capital losses and missing out on offsets. None of this has to be complicated. Get yourself a good crypto tax tool, keep your records clean throughout the year, and if your situation is complex, especially with DeFi, don't be afraid to spend a bit on a specialist accountant. It's almost always worth it. If you found this helpful, please give it a thumbs up. It genuinely helps this channel more than you'd think. And if you've got questions or you want me to do a deep dive on any of these topics, drop a comment below. I'll catch you in the next one. Cheers.